Viewers at home, you are welcome to my presentation on sensitivity analysis. Sensitivity analysis. Sensitivity analysis, or what if analysis. You either call it sensitivity analysis or you call it what if analysis. Sensitivity analysis is a method of uncertainty analysis. A method of uncertainty analysis which tests the effect. It tests the effect on the expected outcome of changes in the value of key factors. Sensitivity analysis, sensitivity analysis is a method of uncertainty analysis which tests the effect on the expected outcome of change in the value of key factors. Sensitivity analysis is a method of uncertainty analysis which tests the effect on the expected outcome of change in the value of key factors. I repeat, sensitivity analysis is a method of uncertainty analysis which tests the effect on the expected outcome of change in the value of key factors. Sensitivity analysis takes each uncertain factor in turn and then calculates the change that will be necessary in that factor before the original decision is reversed. I said sensitivity analysis takes each uncertain factor in turn and then calculate the change that would be necessary in that factor before the original decision is reversed. Sensitivity analysis takes each uncertain factor in turn and then calculate the change that will be necessary in that factor before the original decision is reversed. Sensitivity analysis can also be called what if analysis. For example, what if demand fell by 8%? What if demand fell by 8% compared to the original forecast? forecast. Would the project still be viable? So that is what if question. So I've told you that sensitivity analysis can also be called what if analysis. Several variables were used in the computation of the project NPV. So among the variables used in computation of the project NPV, variables used in NPV's computation include: number one, the sales revenue or selling price. 2, variable cost. 3, incremental fixed cost. 4, the outlay of the project or investment. 5, the scrap value. 6, the project life. 7, cost of capital. So all these are the variables used in the computation of the project NPV. Remember, the decision rule for the NPV is to accept the project with positive NPV. Where a project fetches positive NPV, that means the project is viable, is to be acceptable. So now, where a project where it is producing positive NPV, by what percentage can any of these variables be changed so that the project will still be tolerable, so that the project will still be acceptable? That means if you change the variable or any of these variables by more than that percentage, that project will not be acceptable again. That is, it will not be producing a positive NPV. What percentage? No, sales revenue is an inflow. You look at it in the angle or area of reduction. What percentage can you use to reduce your selling price or your sales revenue so that the project will still be acceptable? That means if you now reduce your sales revenue by more than that percentage, the NPV of the project will be negative and the project will not be acceptable again. So that is the sensitivity to sales revenue. Then, what percentage? No, variable cost is an outflows. You look at it in the angle of an increase, in the area of increase. What percentage by which your variable cost can still be increased and still have a positive NPV? That is, what percentage can you use to increase your variable cost so that the project will still be available, will still be acceptable? That means if you increase that project by more than that percentage, that project will not be acceptable. That is what we mean by sensitivity to variable cost. Sensitivity to incremental fixed cost, you are looking at the percentage increase in fixed cost that you can make and still report positive NPV. And that means if you increase your project if you increase your incremental fixed cost by more than that percentage, the project will not be acceptable again. It will be producing a negative NPV. That is what we mean by sensitivity to incremental fixed cost. Then sensitivity to initial outlay. By what percentage can your initial outlay be increased since it is an outflows? So, and still report positive NPV. That means if you increase your initial outlay by more than that percentage, the NPV will be negative and the project becomes unacceptable. That is the sensitivity to initial outlay. Sensitivity to scrap value. Scrap value is an inflows. So you look at it in the area or angle of reduction. By what percentage can your scrap value be reduced and still have a positive NPV? That means if you now reduce your scrap value by more than that percentage, the NPV becomes negative and the project becomes unacceptable. That percentage change in the scrap value, that is the sensitivity to the scrap value. Then the project life. By what percentage can the project life be reduced and the project will still be acceptable? That means if you reduce the project life by more than that percentage, the project becomes unacceptable. So that is the sensitivity to project life. Then sensitivity to cost of capital. By what percentage can the cost of capital be increased and still have positive NPV? That means if you increase your cost of capital by more than that percentage, the NPV becomes negative and the project becomes unacceptable. Therefore, now want to consider the formula used in the computation of sensitivity. Number one is sensitivity to selling price. Selling price. That will be NPV of the project. That means you take the positive NPV over PV of sales revenue times 100. 2. Sensitivity to variable cost. Sensitivity to variable cost, and that will be NPV of the project over the PV of the variable cost. NPV, net present value of the project, over PV of the variable cost times 100 over 1. Number 3, sensitivity to incremental fixed cost. That will be equal to the NPV of the project over the PV of the incremental fixed cost times 100 over 1. Number 4, sensitivity to initial outlay. Sensitivity to initial outlay. That will be NPV of the project over PV of initial outlay times 100 over 1. Number 5, we have sensitivity to scrap value. Sensitivity to scrap value, and that will be NPV of the project over PV of scrap value times 100 over 1. Number 6, sensitivity to project life. Sensitivity to project life, and that will be project life minus break-even point of project life project life minus break-even point of project life over project life. Then we also have sensitivity to cost of capital. Sensitivity to cost of capital, and that will be equals to the IRR, internal rate of returns, IRR minus cost of capital over cost of capital times 100. Then we also have sensitivity to sales volume. Whenever we mention the word sales volume, we are referring to contribution. Number 8, sensitivity to sales volume. That will be MPV of the project over PV of sales volume, that is PV of contribution, times 100. That is the sensitivity to the sales volume. These are the formula we want to consider. So we therefore want to take a work example. Now, example. We have Basia Co. is considering investing $500,000 in equipment to produce a new type of ball. Sales of the product are expected to continue for 3 years. At the end of which the equipment will have a scrap value of $80,000. Sales revenue of $600,000 per annum will be generated at a variable cost of $350,000. Annual fixed cost will increase by $40,000. A. Determine whether on the basis of the estimates given, the project should be undertaken. Assuming that all cash flows occur at annual intervals and that Basia Co. has a cost of capital of 15%. B. Find the percentage changes required in the following estimates for the investment decision to change. 1. Initial investment. 2. Scrap value. 3. Selling price. 4. Unit variable cost. 5. Annual fixed cost. 6. Sales volume. 7. Cost of capital. 8. Project life. That is the question. Now, the solution. The name of the entity in question is Basia. Basia Co. In requirement A, you are to determine whether on the basis of the estimates given, the project should be undertaken, assuming that all cash flows occur at annual intervals and that Basia Co. has a cost of capital of 15%. We want to assess the viability of this investment project by computing the net present value of the project. Let's have the year, let me have items and the cash flows. cash flows. Now, back to the question. We have Basia is considering investing $500,000 in equipment to produce a new type of ball. This is the initial investment. Initial investment, we said that should be treated as an outflows in year 0. Initial investment, 500,000. That should be treated as an outflows in year 0. Back to the question. Sales of the product are expected to continue for 3 years. The project life is 3 years. At the end of which the equipment will have a scrap value of $80,000. This is the scrap value. We said that should be treated as an inflow at the end of the project life. That is to show that this 80,000 will be treated as an inflow in year 3, since the project life is 3 years. Now, sales revenue of 600,000 per annum will be generated. So, sales revenue per annum, that is year 1 to 3. We have the sales revenue of 600,000. Revenue is an inflows. Sales revenue of $600,000 per annum will be generated at a variable cost of 350,000. The 350,000 will have variable cost of 350,000. That is an outflows in year 1 to 3. We have variable cost of 350,000 outflows. Back to the question. Annual fees cost will increase by $40,000. This is an incremental fees cost. That will also be treated as an outflows. Year 1 to 3. 1 to 3, we have fees cost of $40,000. That will also be treated as an outflows. Now, these are the information provided. Remember, I told you that this 80,000 is being the scrap value. Equipment will have a scrap value of $80,000. We said the $80,000 should be treated as an inflows at the end of the project life. So in year 3 now, you have the scrap value of $80,000. That will be treated as an inflows at the end of the project life. Now back to the requirement. Determine whether on the basis of the estimates given, the project should be undertaken, assuming that all the cash flows occur at an annual intervals and that Basia has a cost of capital of 15%. So you are going to discount your cash flow discount factor at 15% cost of capital. So then we also have the present value. Now, since these years were grouped, the discount factor in year 0 will always be 1. And the 3 years period were grouped, year 1 to 3. Since the years were grouped, the periods were grouped from year 1 to 3, then you are going to compute the cumulative discount factors for year 1 to 3. So we have cumulative discount factor, and the formula is the annuity formula, 1 minus 1 plus r raised to power minus n over r, where r is 15% and the number of years is 3 years. So we have cumulative discount factor at 15% cost of capital. We have 1 minus 1 is 0.15, 15% is 0.15 plus 1. That will be 1.15 raised to power minus n. Number of years is 3 years over r. R is the discount factor, which is 15%, 0.15. So, cumulative discount factor at 15% cost of capital for 3 years is approximately equal to 2.283. So, for year 1 to 3, we have 2.283. 2.283, year 1 to 3 2.283, year 1 to 3 2.283. Then for year 3, since this is only 1 year, year 3, you are going to make use of this formula. Discount factor will now be raised to power minus n. So where n is 3, so we have 1 point, r is 15%, which is 1.15, raised to power minus 3. Our n is 3. So we have 1.15 raised to power minus 3. That gives us 0.658 approximately. That is the discount factor for the third year. 0.658. Now we calculate the present value. 500,000 times 1 will be 500,000. 600,000 times 2.2883. That gives us 1,369,800. Then 350,000 times 2.283. That gives us 799,050. This is negative. 40,000 times 2.283. That gives us 91,320. Negative as well. 80,000 an inflow times 0.658. Then we have 52,640. So you sum it up. 52,640 minus 91,320 minus 799,050 plus 1,369,800 minus 500,000. So we have 32,070 positive NPV. Our net present value is positive. Therefore, the project is viable and it should be undertaken. That is the answer to requirement A. That is, the project should be undertaken since it reported a positive net present value. Now back to requirement B. Find the percentage changes required in the following estimate for the investment decision to change in initial investment. That is B1, sensitivity to change in initial investment. After this, sensitivity to change in initial investment, I said is NPV of the project over PV of initial investment times 100. The net present value of the project as calculated is 32,070. NPV is 32,070 over PV of initial investment. The present value of initial investment is 500,000. The present value is 500,000. We have divided by 500,000 times 100 over 1. Therefore, sensitivity to change in initial investment will be 32,070 divided by 500,000 times 100. We have 6.4%. Therefore, sensitivity to change in initial investment is 6.4%. Then B2. You have to calculate the sensitivity to change in the scrap value. Sensitivity to change in the scrap value, and that will be NPV of the project over PV of scrap value times 100 over 1. NPV of the project as calculated is 32,070 over PV of the scrap value. This is the scrap value, which is 80,000. The present value of the scrap value is 52,640 divided by 52,640 times 100 over 1. So 32,070 divided by 52,640 times 100, we have 60.9%. 60.9%. That is the sensitivity to the scrap value. We have 60.9%. Then B3. B3, sensitivity to selling price. Sensitivity to change in selling price, which will be NPV of the project over PV of selling price or sales revenue times 100 over 1. The NPV of the project as calculated is 32,070. 32,070 over our sales revenue is 600,000. The present value of the sales revenue is 1,369,800. 1,369,800 times 100 over 1. So we have 32,070 divided by 1,369,800 times 100. That gives us 2.3%. 2.3%. That is the sensitivity to selling price. B4. You have to calculate the sensitivity to change in unit variable cost. B4, sensitivity to change in unit variable cost, and that will be NPV of the project over PV of the variable cost times 100. NPV as calculated remains 32,070. 32,070 over PV of the variable cost, and our variable cost is 350,000. The present value of 350,000 is 799,050. We have divided by 799,050 times 100 over 1. So we have 32,070 divided by 799,050 times 100. That gives us 4.0%. 4.0%. That is B4. B4 is 4.0%. Now, we want to take the B5. B5, sensitivity to change in annual fixed cost now. Annual fixed cost. Annual fixed cost, B5, sensitivity to change in annual fixed cost and that will be NPV of the project over PV of the fixed cost times 100 over 1. NPV as calculated remains 32,070. 32,070 over present value of the fixed cost. Our fixed cost amounted to 40,000, and the present value of the fixed cost is 91,320. So we have divided by 91,320 times 100 over 1. Therefore, we have 32,070 divided by 91,320 times 100. That gives us 35.1%. We have 35.1%. That is the sensitivity to change in annual fixed cost. Now we want to take B6 now. B6. 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 We have sensitivity to change in sales volume. I told you that sales volume is referring to the contribution. That means you will need to determine the contribution. Remember your contribution now. Now let's calculate our contribution. Contribution, which is sales. Our sales amounted to 600,000 less variable cost. Variable cost amounted to 350,000. If you subtract 350,000 from 600,000, you'll be left with 250,000. And that 250,000 is our contribution margin. Contribution amounted to 250,000. So now let's discount it in order to get its present value. You have here, you have the cash flows, which is our contribution. You have the discount factor at 15% cost of capital, and then the present value. And the years involved is year 1 to 3. Our contribution is 250,000. The discount factor for 3 years, year 1 to 3, we have 2.283 as calculated earlier. 2.283. And what is the present value of that? 250,000 times 2.283, we have 570,750. That is our contribution, which is the sales volume required. Then sensitivity to sales volume, which will be the NPV of the project over PV of sales volume. I told you that the sales volume is talking about the contribution. And NPV of the project as calculated earlier is 32,070. 32,070. PV of the sales volume as calculated, we have 570,750. 570,750 times 100 over 1. 32,070 divided by 570,750 times 100. That gives us 5.6%. Sensitivity to sales volume is 5.6%. That is the requirement 6. The next one, Roman figure 7, is the sensitivity to change in cost of capital. Sensitivity to change in cost of capital. I said that is IRR. IRR, that is B6, B7. B7. Sensitivity to change in cost that is IRR minus cost of capital over cost of capital times 100. Our IRR is internal rate of returns. Then for IRR, 2 NPV must be calculated. And the first NPV is 32,070. That is the net present value. 32,070, and that is positive. Then you will need to calculate another net present value which must be negative. The first NPV was calculated at 15% cost of capital. Now let's use a rate that is higher. Let's try 20%. Try 20%. So we have here, you have items just like the first one. Then you have cash flows. Cash flows. You have the cumulative discount factor at, now we are trying 20%, and the present value. The first, we have year 0, which is the initial investment, which was given to be 500,000. Discount factor at 20% will still be 1. 500,000 times 1, that will still be 500,000. Then the next one, year 1 to 3, we have the sales revenue of 600,000. Year 1 to 3, we have sales revenue of 600,000. Now, cumulative discount factor for year 1 to 3 at 20%, using the same annuity formula we have used in the first NPV we've calculated. 1.2 raised to power minus 3. You are subtracting it from 1 divided by 0.2. We have 2.106. 106. Now the net present value, the present value 600,000 times 2.106. That gives us 1,263,600. Then the next item is variable cost of 350,000. Year 1 to 3, variable cost of 350,000. Discount, cumulative discount factor still remain 2.106. And the present value of that, we have 350,000 times 2.106. That gives us 737,100. The next item is fixed cost of 40,000. Year 1 to 3, fixed cost 40,000. Cumulative discount factor at 2.106. 40,000 times 2.106. That gives us 84,240. That is fixed cost. The last item is the scrap value of 80,000. Year 3, scrap value of 80,000. That is an inflow. Then the discount factor at 20% for year 3 alone. 1 divided by 1.2 raised to power 3. That is 0.579. 579. What is the present value of that? 80,000 times 0.579. We have 46,320. 46,320. Our net present value now will therefore be, when you subtract, minus 84,240
84,240 minus 737 100 plus 1,263,600 minus 500,000. The net present value is negative 11,420 negative. That is NPV.
Now let's compute the IRR, internal rate of returns by interpolation. We have lower rate plus the net present value at the lower rate over net present value at the lower rate minus the net present value at higher rate, then we have into higher rate minus lower rate. That is the formula for calculating the internal rates of returns by interpolation. Now, what is our lower rate? Our lower rate is 15%. 15%, and the NPV at lower rate is 32,070. Lower rate is 15% plus the net present value at lower rate, which is 32,070 over net present value at lower rate 32,070 plus we have minus net present value at higher rate. The net present value at higher rate is negative, and we have 11,420 negative, and the rate we used is 20%, which is higher rate. So the minus, since that one is negative, that means this becomes plus 11,420 into higher rate 20% minus lower rate is 15%. So we have 15 plus 32,020 plus multiplied by 20 minus 15, that will be 5 over what is the sum of the denominator? 32,070 plus 11,420. The denominator is totaled 43,490. So if you have 32,070 times 5 divided by 43,490. So we have 15 plus 3.69. So when you sum it up, therefore our IRR, internal rate of return, is 18.69%. Therefore, sensitivity to change in cost of capital, we said the formula is IRR minus cost of capital over cost of capital times 100. Our IRR, internal rate of return, is 18.69 minus the cost of capital. Our cost of capital is 15% minus 15% over 15% times 100. So we have 18.69 minus 15, then we have 3.69 divided by 15 times 100. So we have 24.6%. That is the sensitivity to cost of capital. The last requirement, that is B8. B8. That is the sensitivity to project life. Sensitivity to project life. B8, project life. B8. I said sensitivity to project life. I said sensitivity to project life. I said that is the project life minus break-even point of project life over project life times 100. That is the sensitivity to project life. The project life is 3 years. What is the break-even point of the project life? The break-even point That is the payback period. Now, when will this project pay back? It's outlay of 500,000. You know, remember, it says revenue of 600,000 will be generated. We have says revenue of $600,000. Variable cost of 350,000 and fixed cost of 40,000. Fixed cost 40,000. 600,000 minus 350,000 minus 40,000. The net cash flows is 210,000. Therefore, payback period will be outlay of 500,000 divided by annual cash inflows of 210,000. 500,000 divided by 210,000. We have 2.34 years. 2.38 years. Now, let's have the break-even point of the project life. The break-even point. Now let's discount the cash flows. We have year. We want to calculate the discounted payback period. We have cash flows. We have the present value. Year 1 to year 0, an outlay was $500,000. In year 1 to 3, we have the net cash flows of 210,000. But let's say let's approximate it to 2 years. Let's forget about 0.38. So now let's just say year 1 to 2, 210,000. Year 1 to 2, 210,000. Discount factor at 15% cost of capital as calculated, year 0 will be 1. Then year 1 to 2 at 15%, 1.15 raised to power minus 2 minus 1 divided by 0.15. For 2 years now, we have 1.626. What is the present value of that? Year 0 will still be 500,000. Year 1 to 2 now, we have 210,000 times 1.626. 341,460. It is still the same if you take the cash flows year by year. By having initial outlays of 500,000, sales revenue of 600,000, but you use year 1 to 2. Variable cost of 350,000, you use year 1 to 2. Then fixed cost of 40,000, you use year 1 to 2. But this one is for year 3. That will be excluded. So it's still the same if you use it that way or you do it this way. So now, what is the net present value of that? Minus 500,000. We have 158,540. So that is the net present value. So you still use your IRR formula, which is by interpolation now. By interpolation. Just using the IRR formula. The break-even point of project life. We have 2 years plus we have 158,540 over 158,540 plus our initial NPV as calculated, which is 32,070. 32,070 times 3 years is the project life minus 2 years. We have 2 plus 158,540 times 3 minus 1 is 3 minus 2, that is 1. Over what is the sum of the denominator? 158,540 plus 32,870. 32,070. We have 190,610. So which is 2 years plus. So if you have 158,540 times 1, it will still remain as 158,540 divided by 190,610. 190,610. Then you have 0.83. So by the time you sum it up, so you have 2.83 years. That is the break-even point of the project life. Therefore, our sensitivity to project life now, sensitivity to project life, which is IRN, which is project life minus break-even point of project life over project life times 100. The project life is 3 years minus the break-even point of project life, which is 2.83, over project life, which is 3 years, times 100. 3 years minus 2.83, which is 0.17, divided by 3 years times 100. We have 5.7%. Therefore, the sensitivity to project life is 5.7%. That is the end of my presentation on sensitivity analysis. Thanks for watching Ezikan.